You're now listening to the Tax Smart REI Podcast, the number one tax podcast for real estate investors. Hey, thanks for tuning into this week's episode of the Tax Smart REI Podcast. Today, we're going to be talking about partial asset dispositions and their powerful but little known tax benefits and how over the course of owning property, it can save you tens, if not hundreds of thousands of dollars in tax savings. We're going to be diving into all of that in just 1 minute. Breaking news, we just launched our brand new newsletter, REI Daily. After talking with clients and fellow real estate investors, one thing was clear. There wasn't a newsletter that delivered real market insights, concise decision-making info, and relevant tax strategy all in one place. So we created it. REI Daily delivers real estate news that won't put you to sleep, real and concise market insights that aid in your decision-making, legislative updates that actually impact your investments, and tax strategies sprinkled in because the IRS does not need a tip. If you're a real estate investor who wants to stay sharp without shifting through all of the clickbait or fluff, this is for you. And to celebrate the launch, you'll have a chance to win a free one-on-one tax strategy call with one of our top real estate experts. No pitch, just strategy. Subscribe now by visiting www.therealestatecpa.com/subscribe. Again, you can subscribe now by visiting www.therealestatecpa.com/subscribe. We'll see you in the inbox, but now right back to the show. We're back, and today we're going to be talking about something called a partial asset disposition, or PAD for short. And we talk a lot about different strategies here on the show, from reps, short-term rentals, and everything in between. But something that we have addressed here on the show, but I don't think gets enough attention, is the partial asset disposition. And this was put in place under the tangible property regulations back in 2014. And it's the same regulations where you'll see the definitive safe harbor and things like that. But it just doesn't get enough attention. I think the reason why it doesn't get enough attention is because it's not that quote unquote sexy of a topic to us. It's one of those things that's more handled on the compliance end, more so than it is strategic from a tax perspective, although I guess it could be, but more often than not, it's a compliance handle thing. So that's why we're bringing it to the forefront here today. This is something we routinely work on with our clients, but we're going to break it down, and then we have some case studies and some other comments to make. Let's just jump right into an overview. Ryan, do you want to give a quick overview of what a partial asset disposition is?
Yeah, so a little bit of like a definition. So basically, we're taking something that is a piece of the property itself. So say like a roof, and we might use different examples here as we walk through these things, but say like a roof, and we are basically disposing of, demolishing, removing, say the old roof and replacing it with a new roof, right? But as the kind of wording is partial asset disposition, we are ripping something out. Obviously, we do something like this with a renovation or rehab, something like that. And so basically, we're being allowed as a taxpayer to recognize a loss on whatever portion of the asset that is being removed or disposed of without having to, dispose of the entire asset, meaning like the entire property. So basically, we've got this roof, and we'll walk through an example here, I think, in just a second. But basically, we're taking off something like a roof, putting on a new roof, whatever the cost of the old roof was that was still there, writing off the entire basis to get a write-off for an immediate expense for us.
Right. So yeah, basically what happens is, like, when you buy an asset or you have an asset, you're going to depreciate that asset, right? And on your depreciation schedule, a roof, for example, is 27 and a half years. So you're depreciating that roof over that period of time. And then what happens is, if you replace that roof, you're typically going to continue replacing, you're going to be depreciating the new roof and then the old one, right? But what the partial asset disposition says, so here's the remaining value of that old roof that you would have been continuing depreciating over 27 and a half years, and saying, you know what, we're going to deduct the entire thing, the rest of the remaining value, in the year that you dispose of it. That's the benefit. You're basically accelerating the deduction. So when you replace an item, you're starting to depreciate the new one. It could also be like an HVAC system. We'll get into more examples here. But you're replacing the old one. You're saying this is the remaining value of the thing we just threw out. And then you're deducting that. And then you're adding the new one to the depreciation schedule. So that's what a partial asset disposition is. And I think as we get through some of the examples, you'll start to see a little bit more about the power of this. But Ryan, you want to give an overview of like this example here?
Yeah. So basically we could say, like going back to the roof, say that you had bought a property back in 2020, about 5 years ago. Say we've done some way to figure out the cost of that old roof, and we've determined that it's, just for easy numbers, let's say $10,000. Okay. Maybe you've got some small multifamily duplex, fourplex, something like that. And you've been depreciating it for 5 years. And again, just to keep the numbers simple, let's say that came to depreciating it for, $2,000 accumulated over those 5 years. So now you've got a basis of that roof for $8,000. 10,000 minus the 2,000 that you've taken has now a basis of 8,000. Now, let's say we're in 2025 and you're going to replace that roof, and the new roof is going to cost you 15,000. Okay. Basically, we're going to capitalize the new roof for 15,000, and the old roof that you've obviously now taken off and disposed of, that roof, that 8,000 that was there, you're getting to completely dispose of and therefore get an $8,000 deduction. So we're capitalizing the new one, 15,000, basically fully writing off the old one for 8,000, and now we immediately get the full cost of that 8,000. And instead of taking that 8,000 over the remaining 22 and a half years, right? Tom and I were just talking about 27 and a half years. Useful life, we already depreciated at 5 years in my example. So we're taking that 8,000, getting to accelerate it, which is oftentimes what we're talking about here with cost segregation studies, bonus depreciation. It's almost like that, but you have actually borne the cost of a new roof, for example. So we're writing off the old one. So it's a nice way to accelerate. A lot of strategy is accelerating deductions and deferring income. This strategy really kind of hits on the first one, which is accelerating the deduction instead of taking it slowly over 22 and a half more years in this example. So getting to immediately deduct it, and you still need to capitalize the new one.
Yeah, absolutely. So this can be powerful over time, and I think you'll see that. We're going to get into some of the real life case studies we've seen here at the firm. But first, before we do that, I just want to highlight some key points here that you need to know if you are going to be considering using partial asset dispositions, which again, if you're going to be doing major renovations to a property over time, this is extremely powerful, and you want to make sure that you're aware of it and that whoever you're working with is taking advantage of it with you. And we'll get to more on that too later. With 2024 officially in the rearview mirror, now's the perfect time to start planning for how you're going to maximize your tax savings in 2025. With major tax changes looming under the new administration and IRS audits on the rise, navigating the tax code alone is now riskier than ever. Whether you're leveraging the short-term rental loophole, claiming the real estate professional status, utilizing passive losses, 1031 exchanges, or anything in between, our expert team of tax advisors at Hall CPA has your back. We'll help you uncover hidden opportunities and avoid costly mistakes that could put you at risk during an audit. With potentially tens of thousands of dollars of tax savings on the line, why wait? Visit www.therealestatecpa.com/podcast to request your free 30-minute discovery call today. Again, that's www.therealestatecpa.com/podcast for a free consultation. Let's help you ensure you keep more of what you earn in 2025. That's all for now, and we'll dive right back into today's episode. Some key points to highlight here. It applies to assets used in a trade or business like real estate. That's what we're talking about here. You must be able to identify the retired component or the part that you disposed of and its cost, or reasonably estimate it. Now, how do you estimate these things? Is a great question. The first way and the most common way to do it is a cost segregation study. So not only do cost segregation studies have value in the ability to use it to bonus depreciate the 5, 7, and 15-year property, but it also helps you evaluate the cost of the components that are associated with your property for the purposes of partial asset dispositions, because it's going to tell you that old roof that we're talking about here is worth Y dollars, right? And that HVAC system you have is worth X dollars, and that the underground plumbing system or the whatever is worth Y dollars. It's Z dollars, right? It's giving you a readout, a breakdown of the cost of all the components in your property, which also helps for this. Now, there's other ways to do it too, although cost segregation study is often the most preferred, and that could be that you have detailed records of, like, maybe you already have the records of the cost of these assets, perhaps from previous renovations that you did. But most often, if you purchase the property, you probably don't have that, which is why cost segregation is so good. And there's another way to do it. This is an IRS approved method, basically using the producer's price index, but it is a pain to do. So that's why cost segregation studies are usually the best way to determine the value of these retired components. So some other key things to note here before we move on is the disposal must occur in the year in which the loss is claimed, or stated another way, you must claim the partial asset disposition in the year in which you dispose of the asset. So for example, if you replace the HVAC system in 2025, you have to take the partial asset disposition on the existing HVAC system in this year, right? There's not really much strategic ways to say, okay, you know what, I'm going to defer it here, defer it there. No, the only way to do that really is to defer the renovation, right? Which obviously in real estate sometimes may not always be feasible, right? And it also must be made timely, usually on the return, which is in play, right? So if we're talking about 2025 partial asset disposition, it needs to be on your 2025 return, okay? Pretty basic stuff here. So some ideal use cases, we already talked about the roof, but it could be HVAC systems, windows, plumbing systems and replacements, partial demolitions during renovations and component upgrades on things like commercial and large residential properties, although it of course applies to single family as well, just to be clear. But moving right along into this, I do want to answer some frequently asked questions we do get around this. And the first one being, when you do a partial asset disposition, remember, this is like basically it's kind of creating a little loss here in many cases. And is this going to be passive or non-passive? And the answer is the same for everything else with real estate losses. It's going to be passive unless you qualify for the real estate professional status, special loss allowance, or a short-term rental loophole. We're not going to go through all those things here today. We already know what they are. We talked about it many times here on the show. You can go check the other episodes out if you don't know what those things are. But long story short, if you're not qualifying for reps, short-term rentals, or the special loss allowance, the loss will be passive for you, okay? Or it will be non-passive if you do qualify for those things. Now, remember, this could still be powerful if you are a passive investor, because you could still use these losses from these partial asset dispositions to help you shelter the rental income that you're generating from other properties, or capital gains from the sales of other properties, either in the current year or in the future if these losses are suspended. So it's still a valuable thing to keep in mind whether you're a passive or non-passive investor. Hey, real quick, if you've been a long-time listener to the show, then you know we give everything away for free, from how to use the real estate professional status and the short-term rental loophole to save tens of thousands of dollars on taxes, to upcoming tax changes, including the potential return of 100% bonus depreciation. We don't hold anything back. And the only way we're able to help more real estate investors is if you rate, review, and share the show. It just takes 15 seconds to leave a quick rating, review, or share with a friend who may find this information useful on their real estate journey. That's all for now. We'll dive right back into today's episode.
I'm just going to jump in here and go through a couple case studies that we have and keep it pretty high level, but just to kind of help you guys understand that we've done this a couple times for those of you listening. So we had someone recently that we're going to have on their 2025 tax return, had $15,000 of plumbing work. So that'll be $15,000 of a write-off is what I mean. Not the new one, but $15,000 plumbing immediately. And then we've got a couple that have come through even for 2024 that we had. We asked a couple coworkers about this. They had an HVAC system that resulted in a $12,000 additional write-off. Another client last year who had a roof that resulted in an additional $4,000 getting written off. And then another client, this one was a passive one and then had an additional $1,000 deducted. And another one that was another roof that resulted in an additional $10,000 write-off. So as you think about these, the numbers that kind of go up and up and up really just depends on the cost and the size of the property. So that's why Tom mentioned a few minutes ago about things like multifamily being a little bit more ideal, because the cost and the size is a bit bigger. And so just as you think about, is this worth it? It's the same with a lot of these strategies. Is the juice worth the squeeze? There is a calculation, you've got some additional time, but there's a lot of good examples and we see them regularly every single year. We have these.
Yeah. These are just a handful of examples that we have. We do this so routinely that it's no big deal to us. Like, it's just what we do. However, I will say this, this partial asset dispositions can be quite powerful. I have one more case study on this. So we had one of our larger clients, when they first started working with us, we reviewed their prior depreciation schedules and we found over $2 million in deductions. And they had a larger portfolio of commercial properties. I'm not going to go too much into the details there. They do like to remain private. Just know that the larger the portfolio that you have, or the more extensive the renovations that you're doing, the more likely that you are to be able to take massive advantage of this. And so it can be powerful in those cases, but just remember, as you have a property, you're eventually going to renovate if you hold it long enough, and you're going to be eligible for something like this. So you want to make sure that you're aware of it and that your CPA is taking advantage. Having said that, we review, I think somewhere between 350 to like 400 people reach out to us every single month looking for help on taxes. And very often they're finding that their current CPA or tax preparer in general is inadequate. And from all the returns that we reviewed, I'm pretty confident in saying that probably 98 out of 100 traditional CPAs, like your local guy, is not doing this for you. They're not allowing you to use cost segregation studies. They're not telling you about them. They're not telling you about bonus depreciation, or they're not allowing you to do basic stuff like home offices and the real estate professional status. Then they're almost certainly not doing this. Now, there's a few good people out there who do this that I've seen. That's why maybe the 2 out of the 100. Chances are, if you're working with a traditional CPA, they're not doing this for you. It's too nuanced and too deeper into the regulations for them to even look at. And for some of our competitors out there, like more people in the tax strategy space, could almost guarantee you they're not doing this either. Again, because it's not something they just go on our website and copy, which is like they like to do. So you want to be working with a shop that does this, and we do this routinely. So if you're working with us, we're filing your tax returns and you're doing renovations, and we're going to be keeping an eye on this for you, and we're going to be taking these deductions. And, like Ryan mentioned, just some examples, 15K deduction in plumbing work, that's pretty substantial. Another one for 10K, another one for 12K. And again, with that one client, we found $2 million of opportunity in there for them. This stuff is substantial, and it's something that you want to make sure you're working with a team that is doing this for you. So that's kind of the point we're trying to make here today is partial asset dispositions can be a very powerful deduction for you. And you want to make sure that you're aware that it exists, and you want to make sure that your service provider is handling this for you. Otherwise, you could be leaving literally tens of thousands, if not millions of dollars of deductions and ultimately tax savings on the table, which nobody wants. So that's a partial asset disposition in a nutshell. Long story short, you are renovating your property. The existing components that are there, you're deducting them all in the same year that renovation is occurring. All right. And that can be quite powerful over time.
One thing, Tom, before we wrap up, for those of you listening and you might be thinking, how do I know if maybe a partial asset disposition was missed? A good indicator would be take a look at your depreciation schedule. If you see a new asset that's been capitalized as an improvement, that is a good indicator that maybe there should be a partial asset disposition. So like we've already walked through roof, HVAC, windows, plumbing, all that stuff. If you're seeing anything like that getting capitalized, that could be an indicator that you need to either check with your CPA to say, hey, is there a disposition here that we can get some additional write-off? And just check that. So just check your depreciation schedule, see if you've got that. That could be an indicator.
And of course, proactively, as you're doing any renovations, that is probably the more extensive the renovation, the more opportunity there is there. But if you're replacing any assets, then that's an opportunity to have that conversation and make sure that this is being done on a proactive basis. So, Ryan mentioned how to look at your tax return to see if it's maybe some missed opportunities, but that's how you also know going forward, which is very simple. It's, are you doing renovations, right? So that's about it for today's episode. I want to keep it short and sweet because this is a topic that is often missed and people overlook, but can be quite powerful. So if you want to work with a CPA firm that does this routinely for their clients, you want to make sure your bases are covered. You want to make sure you're not missing these deductions. You want to make sure that the past deductions that you might be able to take are being evaluated, at least so you know what's going on. Then we'd be happy to learn more about your situation and how we can help. You could follow the link in the show notes to book a free 30-minute discovery call where we will see if we're fit to work together. And if we are, we'd love to help you on things like the partial asset disposition and everything else we talk about here on the show. So looking forward to speaking with you, and we'll catch you on the next week's episode of the Tax Smart REI Podcast.